hot in the mortgage market? Join us for another episode of FDM Brews to learn more about trends and updates in the mortgage industry that can help you get your clients pre-approved for the home of their dreams.
Cheers, gentlemen. Good morning.
Morning, Cindy.
Good morning, Cindy.
How are we doing this fine morning?
We're just ducky this morning. It's wet, but it's great. It's ducky weather today, so we're ducky this morning.
Ducky. Hey,
Ducky.
Ducks always float on top of the water, so
Absolutely.
It's a good place to be. You don't want to be underwater, right?
Yep.
Speaking of underwater, I think one of the hot topics in the real estate market right now is, are we heading for another crash, right? Like, oh my gosh, interest rates, the sky's falling, and then what's happening here? So what are your thoughts?
You know, Cindy, that's probably one of the most popular questions we get today, right? Are we going to relive 2008 and 2009, right? Or is it a correction, crash, bubble? What are we facing? And people have a memory, right, of 2008. That really wasn't that long ago. And you know, that market correction was devastating. I think a lot of the factors today, which we're going to go over, actually point to a different outcome. But the first thing I want to talk to people about is 2008 wasn't the only correction that we've seen in the marketplace. As we know, I'm the oldest one on the call, so I've lived actually through three of them. And, you know, it's always the same, right? So we see the market run up a little bit, then we see a correction in the marketplace, and then we see the market recover. And, you know, a lot of times I like to put the corollary to what happens in other financial investments, right? So when we look at what's happening in the real estate market, and we look at what's happening in the stock market, we talked about in one of our last recordings that, you know, the market has lost $7 trillion, right? The aggregate three major indexes, right? $7 trillion since January 1 today in 2022. But what's interesting, because I lived through it, you know, Black Monday, October 19th of 1987, right? The stock market was over $2,000. It was, you know, just the S&P was over 2,000. Market crash, lost 22% value. And I lived through that. And I was, you know, I wish I could say I was like 7, but I wasn't. But, you know, I lived through that. And I remember everybody, because I've worked with a lot of financial advisors, everybody's panicked. Oh my God, the market's never going to get over 2,000 again. Black Monday, take your money out of the stock market as the market's over 30,000 today, right? So even, yes, we had a correction. Now, over the last almost 40 years, what's happened? Market's gone up, it's leveled off, it's recovered. It's gone off, it's leveled, it's recovered. Real estate market's the same way. We've lived through market corrections and opportunities, right, within those, and the housing market's the same. Right around the same time, we had the savings and loan crisis, right? We had the savings and loan crisis, property values cratered. And I guarantee you in 2022, properties are worth more than they were in 1987, 88, and 89 when we lived through the savings and loan crisis. In the early 90s, we lived through the Russian debt crisis, which also created a dislocation in the real estate market. And everything in 2022 is worth more than it was in the late 90s. And the same thing in 2008. I was a contrarian in that market. I was telling people, don't sell your house, right? Don't panic. Don't get out of it. Everybody was making fun of me. Oh my God, the market's terrible. Sell your house, you're underwater, get out of it. Everybody that sold their house in 2008, I'm sure in 2022 wishes they kept it, right? Because the market has recovered. So, but there are some fundamental differences in today's market that don't point to a bubble. But I think it's important we have to deal with perceptions because our clients' perceptions become realities. Memories are short, right? They remember what happened in 2008, 2009, 2010. How do we help them with confidence? And if I believe that the market was trending in a different direction, I would tell everybody, right? This isn't a sales thing. This is actually analysis based on what we're seeing in the market and what made it a little bit different. So why don't we talk about why I don't think it's a crash, why I don't think it's a bubble, why I think it's a normalization and leveling of the market, and all of the economic data points to that.
I'm fascinated. I can't wait to hear it.
Perfect. Okay, why we're not headed for a housing bubble, Cindy? Nithesh.
So, you know, Brett, you mentioned, right, you know, crash, correction, or bubble, and you brought up a couple of words, normalization and correction, right? And normalization is really what we're facing. So what's happened in the housing market, you know, since World War II? So since 1945, you can see clearly in the graph that it is consistently going up. There may be some drops, you know, Brett mentioned in the real estate market, in the stock market. it's not always up. It goes up, it comes down slightly, then it goes back up. But eventually it always goes back up, and we are up right now.
What's interesting historically, Cindy, house appreciation is about 0.5% above the rate of inflation. Now, not today's inflation, right? Not the 8% we're having today. Although we are seeing housing appreciation exceed current inflation. Historically, it's about 0.5% above the rate of inflation, which is about a 3% return. But that's a 3% return on a leveraged asset, which is a very powerful tool. So we're seeing general house appreciation on a steady stream upward. Whoops.
So forbearance was a large concern, right? And the market thought that due to forbearance, there would be a crash, or there would be a huge impact to the market. But we can see that, yes, forbearance rates were high in early, well, COVID started February, March of 2020, right?
March
And
2020.
so, yeah, and so as soon as the allowance for forbearance was reported, it skyrocketed. Forbearance rates went up, but as you can see, it's under 700,000 right now. It was close to 5 million when it started, under 700,000, and it's consistently dropping. So that is not a large concern in the market anymore.
Cindy, this is an important data point, because what happened in 2008, 2009, 2010, which pushed people into foreclosure, was loan modifications, and people got in the habit of not making mortgage payments, right? So the thought was, when people went into forbearance, human nature is this: if I'm not making the mortgage payments, when I have to start making them, I haven't changed my budget, I haven't changed my lifestyle, and I'm not going to make the mortgage payments. But two things have created a difference here from 2008. The pandemic was a once in a century experience, right? So people had to pause, and the forbearance program allowed them to do that. But two things are keeping people from going through the path of I'm not making my payments. One, what's happened to interest rates? They went to historic lows, right? So a lot of people were able to refinance, lower their interest rate to levels like 2 to 3%, right? So you come out of forbearance and now you have a low payment. Number two, what's happening to rent at the same time? It's going up, right? So there's no place to go, right? You can't say, okay, wait a minute, I'm going to go let go of my house. I'm going to go to foreclosure and I'm going to rent somewhere, because rent's probably what? More expensive than buying. So that has pushed people to come out of forbearance and then get back into making their mortgage payments.
So again, talking about forbearance, the big concern was what was going to happen to the borrowers when they came out of forbearance. We thought that it would cause a huge crash in the market because of what would happen as they exited. Were they going to be able to make their payments again? But the truth is, here's some information: 37% were paid in full, meaning even through forbearance, some folks continued to make their mortgage payment. They were under the forbearance program, but never actually utilized it. They kept making their mortgage payments. Loans were paid in full, right? Loans paid off. And a lot of folks, as Brett just mentioned, took advantage of low interest rates. And they refinanced. They created affordability through crisis, essentially, right? Rates went down. They saw the advantage, and instead of stopping their payments, they realized, okay, I could actually take advantage of these low interest rates and put myself in a position to create affordability, right? And then 11.4% past due payments were brought current. So a huge portion of the market that were in forbearance actually paid in full. Now, 44% were workouts of repayment plans. So they actually created a plan for when they came out of forbearance. What were they going to do? Loan deferrals, meaning their payments stayed the same and they're defer whatever the forbearance amount was to a later time, meaning they're still going to make those payments, but it doesn't have to be paid in full at this current time. And 15%, they modified their loans. So again, creating affordability. They modified their loan into a new loan where they were able to make that payment. Now, 18% were still in trouble. No loss mitigation plan. They didn't have an actual plan for what was going to happen after they came out of forbearance. And a small portion of that, we're looking at short sales, deed and lose, and repayment plans.
Mm-hmm.
This is an important point, Cindy, because part of what drove the housing dislocation in 2008 was the law of supply and demand, right? A lot of people went to foreclosures. You had all this distressed inventory hitting the marketplace, right? That drives values down. Only 1.3% were short sales, foreclosures, deed in lieu of. So that stopped a influx of massive inventory hitting the marketplace. The modification plans, people are looking at those because there's no place for them to go. So that means inventory is not going to hit the market as well. Supply and demand matters, right? That basic economic principle doesn't change, right? So if you don't have this huge influx of supply like we did in 2008 with all these distressed properties hitting the marketplace, right, you're not going to see as much downward pressure on the market as we've seen in the past. Whoops. Now, one of the things we have known, right, we have to be honest, right, we've learned from history that prices can fall. They fell in the 80s, they fell in the 90s, they fell in the early 2000s, right? Okay, what's happened after every time that they've dislocated at some point in time? If you bought a house in 1980, it was worth more in 1990. If you bought a house in 1990, by 2000, it was worth more. Same thing with 2000 to 2022. Now, within that time period, we've seen markets of dislocation leveling off, but what happened? At times, they've always gone up, right? That fundamental process is really not going to change. Why not? Well, first, we talked about distressed inventory hitting the marketplace. Now, there's a huge fundamental change, right? What drove default risk from 2000 to 2021? The early 2000s, if you look at the red, that was product risk. We collectively as an industry, and we blame lenders, no. The reality is there was a lot of product risk in the early 2000s. From 99 to 2010, we had stated income, stated assets, stated appraisal, stated social security number, stated person. I don't know. You could state anything and get a loan, right? So you had this product risk that was embedded into the marketplace. And then a lot of that product was inappropriately applied to our buyers, right? You know, the whole thing about stated income loans, I've been doing this a long time. They were stated income loans in the 80s and the 90s, but you had to be self-employed. You had to show assets. You had to put money down, right? So you got rid of the layers of credit risk. So those loans performed. You know, I call this, and Nithesh will tell you, I call this the dark period of mortgage banking and real estate lending, right? We got stupid. Everybody chased stupid, right? Buyers chased stupid, realtors chased stupid, lenders chased stupid, and we ended up with a mess. Now, what changed? 2010, right? We started now getting credit discipline back into the marketplace. So that product risk got out of the way, right? We're not doing stated income loans, right? You're not taking two government workers who want to live in an $8 million house that you can go to the Washington Post at the beginning of the year and find out exactly what a GS-14 makes and then say, oh, yeah, they make $1 million. Well, no, the Washington Post says they make 140, right? So that product risk came out of the marketplace. Now you've got historically low interest rates. Borrowers qualify now because we have to verify the income. We have to verify the cash, right? So their ability to afford the loan has been verified and rates are at historic lows. So people aren't going to leave their current product because there's no place for them to go. So that mitigates how much inventory is going to hit the marketplace and how much buyers are going to default in that regard.
Yeah, and Brett, you brought up a great point, right? It's there was no risk offset back then, and you were looking at as you mentioned. I mean, you could state everything. You could state income, credit, assets, whatever you
State
wanted.
who you are.
Yeah, exactly. Now we're looking for the industry has shifted, and you talked about counseling, risk counseling, essentially. And we're looking for compensating factors on loans to protect the real estate market, the mortgage industry. Basically, if you have low credit, you need high down payment or high income. If you have low assets, you need high credit or high income. So everything is offset by something else. If you have low of something, you need high of something else. You can't just have low of everything. Low down payment, low credit, low income does not exist anymore.
Correct. And as a result, Cindy, look what we see here. We talked about distressed inventory hitting the marketplace. Now, distressed inventory brings values down to a market, correct? So look, 2008, 2009, 2010, 2011, the amount of foreclosures, 2.3 million, 2.8 million, 2.9 million. What happened? All of that inventory hit the market, at the same time? Law of supply and demand. I've got a huge amount of supply. People were worried about the real estate markets. The demand dropped. What happens? Property values tanked. Now, look here. Because historically low interest rates, we're verifying the credit, we're verifying the income, we're verifying the cash. There's risk, credit risk profiles have come out of that market, right? The credit risk has been taken out of the market, only 78,000. Now, this is the height of Corona, right? 151,000 and 78,000 foreclosures, right? Versus 2.9 million. And this is the height of the pandemic. People were losing their jobs. People were furloughed. People, were dislocated from their employment. But what? They kept making their mortgage payments. That means that inventory that's distressed is not hitting the market. Now, lending standards, we already talked about this. Chasing stupid, the red, right? This big red is chasing stupid, right? We all chase stupid. Now we've gotten sensible, and you can see that credit discipline, right? Look at the segment of the loans, right? Below 620 have dropped. Right. So we've got a better quality of buyer, more able to make their mortgage payment, which means they're not going to go to default. Now, here's the other part. When we were chasing stupid, and you look at affordability relative to your overall income, right? We looked at this point, we're 7.2%, right? We're looking at the household debt service ratio for the mortgage as a percentage of their income. This is a very high number. Right now, overall, that's dropped today, partly because of income increasing, rates historically low. So right now, mortgages are more affordable than they ever have been, even with increasing interest rates as a percentage of your overall income. That's a key metric, Cindy, because it says that even if housing values have gone up, I have a lot of what we call disposable or residual income that I can use to pay my other expenses, so the mortgage is less risky. This is important because inflation and energy cost, and I think one of the things that was lost in 2008 is also when we had this energy bubble, right? That's the last time gas was at about $4 a gallon. But the problem is too much of the total housing income was allocated to the mortgage. It didn't give you room to cover for that increased energy inflation. Today, it's a much lower number, which gives us room to cover some of the energy inflation we're experiencing and are going to continue to experience. Mortgage payments virtually unaffected. When we're looking at the difference of people taking cash out, right? And that's a big issue. People now are looking at repositioning their cash again to pay off consumer debt, right? We had big shocks in payments when people were doing that in the early 2000s. That's not happening now. So that's a good thing. People aren't taking all their cash out, getting a payment they can't afford, and then getting out of their property, right? That's not occurring today. That happened in the early 2000s, right? People say, okay, wait a minute. I can't make my payments. I'm taking all my cash out, and then I'm going to leave, right? That's not happening today. I don't expect that to happen now, because when you take your cash out, there's still no place for you to go, right? And have an affordable housing payment from a rental standpoint. What's ahead, Tish?
So what's ahead, right? What are we seeing? What are we expecting to see after everything Brett's discussed? So how is this going to impact home values, right? In 2022, 9% increase. Now, Brett mentioned earlier, home values historically have gone up at about 0.5% over the rate of inflation, and it's about 3% a year. Now, this year, and as it's been the last couple of years, it's been very different. Market value and home prices have gone up significantly. Now, rate of inflation, historically, I said, is about 2.5. Now, right now, it's very different. Inflation is high. So, of course, 2022 market is expected to go up about 9%. But then it's going to teeter off, and it's still staying at historical rates, right? About 3%. So about 4.74 in 2023, going down to about 3.5 in 2026.
This is a kind of blending of multiple forecasts, Cindy, between the MBA, realtors, and other analysts looking at where they are. Where we want to be careful is market perception or buyer's perception, right? They've seen the last 2 years, I got 10%, 12%, 18%, 20%. The market's going to level off. It doesn't mean the market's tanking. It means the market's normalizing. If you look at this, going from 9% to 3% is a normalization of the market. It's not a market dislocation. It's a market normalization. two things are going to drive this. One, inventory still remains a challenge, right? Housing permits and other regulatory things that are stopping new homes from coming into the marketplace is a problem, right? And, people that have refinanced at 2 to 3%, they're not going to put their houses on the market. Now, we are seeing some sellers who have, maybe like I was, right, where I wanted to right size, we're seeing them come back into the market now. So you're going to see supply and demand, because demand is going to remain high. I'm going to talk about that in a second. So that'll keep property values relatively stable. Stable, though, is not what we saw in 2020 and 2021. So we want our buyers to understand normalization in the market is okay. Normalization doesn't mean crash, right? And we want to make sure people understand that in the marketplace.
So the cumulative appreciation by 2026, again, we talk about the rate of inflation and how it affects the housing market. So at 3% a year, pessimists who are expecting, the lowest increases are still saying that with, it's going to be about 10% between now and then. And all panelists are 26%, and optimists are saying 46%. Now, Brett, I know, we discussed this yesterday, and you've been doing this a long time. You have a lot of experience in the market. You follow the market, and you're expecting it to be above 10%.
Yeah, I think we're going to be here, right? I think we're going to be in between these two, Cindy. I'm not here now. The people that are on the optimist side, and generally I'm an optimist, right? Extremely optimistic, right? They're looking at demographics are important, right? So I used to teach a class called Selling to Millennials, right? And the time I was talking about that, everybody's wondering why millennials weren't into the marketplace. So that entire class was, how do you get them in the marketplace? And I taught that for like 5 years. Well, then now they're in the market, right? And they're the single largest segment of the population. They delayed housing formation. Housing formation is a big driver to move people into buying real estate. So we have I'm a baby boomer. I used to be part of the single largest segment of the population. We're no longer the single largest segment of the population. Millennials are now. They delayed housing formation. Now the optimists are saying that segment of the population now is coming into the marketplace. So demand will still outpace supply, and that will give you a more rapid appreciation. I think we fall into here because I believe that demand is still going to be high, right? But I also believe that supply, and we talked about this at the open, supply will continue to come into the marketplace. So that will probably put us in between here. I think we'll be in cumulative, not 10% per year or 46% a year, but over 22 to 26. I think the cumulative appreciation will be somewhere between 10% and 20% for the year, because 3.5% to 4% per year over the next 4 to 5 years puts us in that range. And that's where I think we're going to be.
So price forecast. Yeah, price forecast. So, as Brett mentioned earlier, it's average of multiple sources, and forecast for 2022, we are talking about rates going up. We're talking about what's happening to the market, but home prices are still expected. All different sources that we're looking at are still saying home prices are expected to continue to go up.
So here, Cindy, we look at these aggregate. Everything that I've done has been an aggregate looking at these 7 forecasts, right? I think the blended is about 9%. That's where we are in 2022. If you look at the first quarter of 2022, housing values have been about 9%. Now, some markets, Marco Island, for example, Naples, other areas, right, that has been a higher appreciation rate. I do expect even in those markets that it'll start to level down, but not a dislocation, more of a leveling down and normalization of the marketplace. We do have some anomalies. We talked about this, in a second home is no longer a second home. That transition to remote work has taken markets like Naples or Marco Island or Jupiter, and people now who don't have to live in New York City to work at Chase anymore has said, wait a minute, am I going to live in the city where everybody's on top of each other and COVID has changed habits? I don't want to do that anymore. I can move to Marco Island, right, and work in New York, and Chase is letting you do that today, right? So some of those markets have a more accelerated value, but at some point in time, right, that's going to flatten as well. So I would expect that 9% market and then falling down to that 3 to 4% market is what we can anticipate, but that's not a correction, right? That's a normalization of the market. Now, where are interest rates headed? I can get rid of all of the next 4 slides. Up. right?
Yeah.
That's where they're going, right? So the forecast, right? We've changed the forecast. When I did some forecasting, and I think we did in Brews, I was saying, look, I expect interest rates to be in the mid fives in 2022. They're there, right? Now I've changed some of that because I didn't expect gasoline prices to get to I filled up my tank the other day. It was $5.19 a gallon.
Yeah.
I remember telling myself when I was driving in high school in the 70s that if gas ever got over $1, I'd never drive again. And, you know, I was a high school kid. What do I know? I mean, $1 a gallon, I'll never drive again. I'm filling up my
Lord.
At 5.19. Yes, I know I'm old. But anyway, so what I think is the Fed has had to take a more aggressive stance to inflation, right? They've already come back and said their monetary policy. So what I think is some forecasts, right, are saying, okay, we're not going to get to 6. I think we're going to get to 6. And Nithesh will tell you, I've been telling our team that probably now for 90 days. We're going to hit 6, right? But that's still a very tenable market. That's where I think we're going to be. So I think rates are going to not peak in the 5s and 5.5. I think we're going to peak at 6, and that's really driven by energy inflation. I don't think anybody anticipated gas, and the AAA and JP Morgan Chase expected gas to hit $6 a gallon by August, right? That's going to put accelerated pressure on interest rates. So I expect this to move into the 6s. What that is going to do is going to force people, because of affordability, they're going to have to look at a lower priced home, right? So that is going to level off some of the crazy appreciation we've seen even in some of the higher price markets. Now, current forecast, right? So change in price. We saw that, over the last 2 years in certain markets, right? We saw year-to-year change in prices, 15% to 19% to 20%. Forecast now is year-to-year price change is probably somewhere around 6% moving forward. And we've already started to see that in some markets, Cindy, that it's starting to flatten, right? Now, inventory levels, why, right? Inventory levels have dropped. We've known when we talked about the purchase power, fighting for the inventory that's out there, right? The year-to-year change was lower. But look, it's starting to trend up. And we talked about the article that we saw this morning is that there's a spike in listings as sellers fear they've missed the market. We've anticipated, we forecasted that inventory would continue to increase, and it looks like that trend is going to continue. So as this bar graph keeps smaller and smaller and smaller, if we do this again in 3 months, this little red number is going to keep getting smaller and smaller and smaller until it starts to be blue, I think probably by the end of the year, right? Mm-hmm. It's trending in the right direction, right? Now it's still a negative, but it's trending in the right direction, right? In a year-to-year inventory, that's what we're looking for, right? It's down, but it's down smaller. And I think that will continue to see happen. Supply and demand matters, right? As long as inventory trends up, property values are going to flatten some. Whoops.
Do you think that the inflation impacts in new construction is gonna strengthen or weaken that inventory of new construction homes? And
I think it is. The challenge you're having, and Cindy, I've been doing this a long time, but this is the first time I ever had a builder tell me, hey, the Smith loan you're working on, if you can't approve them, that's okay. Why? Because their cost, right? They went into that contract in 21, right? And their cost in 22 have gone through the roof. And literally, I'm not exaggerating, Cindy. Now it's not the NVs of the world, but we deal with a lot of, let's say, mid-market builders that build 20 to 40 houses, right? Hey, yeah. Normally I'd be really pushing you to get that done. But, if you don't, that's okay. Well, one, they know they can put it on the market, right, and sell it for more, right? Mm-hmm. And their lumber costs have gone up 40%, right? Or their appliance costs have gone up 25%, right? They're trying to figure out how to recover that. So in 37 years, it's the first time I heard anybody say, if you don't get it approved, we're okay with that. So
yeah, Brett and I had a call with a builder. We were on the phone, and it's the sales rep is trying to make the deal happen, right? And sure. There are some hurdles that we were trying to overcome, and the sales rep is like, look, I'm being told that if you can't do it, don't worry about it, but I want to make this happen. And we're like, hey, we're with you. We want to get this buyer into the home. But yeah, I mean, it's not something we've seen before.
It is. I think that, from a builder standpoint, I think they're concerned. We do a lot of builder business, and they're concerned about, the raw material cost delays in doing that. So, I think that is going to put an issue on new home inventory. We've seen actually new home sales drop over the last 3 or 4 months, partly because of this.
Mm-hmm.
But here's what I think is going to happen, Cindy, is 2 things. I can say with 100% confidence, I think the market's going to level. I've been saying that probably for 9 months, that the market would start to level off or normalize, right? You can't see this crazy rate of appreciation continue. Market normalization is very different than a crash or correction.
Mm-hmm.
2 things make fundamental differences, right? Nobody's chasing stupid over the last 5 years. So people that are in the homes they are now, right, can afford it, right? So that means distressed inventory is not going to hit the marketplace. Now, let me put a caveat out there, right? So I am concerned about energy inflation,
Mm-hmm.
right? And the impact of that, right? And, sustainable energy at $6-7 a gallon per gas is never going to work, right? You're going to crush our economy. And what will happen if, that's my caveat, right? If energy inflation gets completely ridiculous, I've heard people say we're going to hit $10 a gallon. Matter of fact, in California, they changed the gas tanks now, add another digit, right? That is going to be a problem, right? So assuming that doesn't happen, assume we level off where we are and we have room where we didn't have in 2008. If you go back and look at historically, that's when gas prices hit this again. But you didn't have room in your housing budget to offset that energy cost. Now you do, right? Number 2, demographics matter. We already talked about it, right? Millennials pushed back family formation. Now they're family formation. Family formation is one of the big drivers to make a housing decision, right?
Mm-hmm.
When we talk about the negotiating thing, you always find the why, right? The why isn't I just decided to buy a house today. The why is I'm starting a family and I need a place for my kids and I need to get roots down, right? So as this single largest segment of the population moves into the marketplace, supply and demand will happen, right? Supply is still relatively low and now it's getting better, right? But it's not all this distressed property, right? So that'll keep property value somewhat buoyed. Why demand continues to stay at pace, right? So supply and demand is a big driver. 2008, we saw a huge spike in supply, 2.9 million foreclosures, and demand, as people were uncertain, drop. You can't have the supply go up here and demand go here and expect values to be the same. But if we have an equilibrium, right, the market will continue to level off or normalize.
Mm-hmm.
The problem is we have to help people understand 3% is normal, right?
Mm-hmm.
I didn't get 20%. Oh my God, it's a bubble. No, it's normal, right? So that's what we have, right? So as long as these 2 things come into place, right? We didn't chase stupid. Demand and supply remain somewhat level, the market levels, right? Doesn't crash. If either one of these get out of balance, 2020, 21, what did we see? We saw huge demand, low supply, prices skyrocketed, right?
Mm-hmm.
Well, it works the same way. You have huge supply and no demand, property values drop. Leveling, which is where because of the demographic side and other things that keep supply relatively level, then the market will normalize. And that's really what we're forecasting.
Yeah, and the thing is, you're hearing in the news, and folks are seeing that appreciation is going down, right? And inventory is changing, and the graphs we're looking at, they see the graphs, and everything is trending downwards, but they're not, understanding that. Yeah, you're going from 9% appreciation to 3.5%, but if you look at it historically, prior to 2020, if you look at 2018, 2019, appreciation was below 4%. And between now and 2025, 26, we're expecting it to normalize and go back to that same rate. It's going to be between 3 and 4%, which is where we were prior to the spike. So, it's just a matter of understanding, what's going on and actually realizing that, Brett keeps saying this word, but it's really what it is. It's not a crash, it's a normalization. We're just going back to how things were.
So what I'm hearing is that I shouldn't expect the same results as Flip That House.
No, you don't want to say that. Right. So, when you work with investors, right, the biggest things about investors is people make money by doing things with like Microsoft, right? they didn't make $4,000 per software. It was a little bit of money on a long thing. Same thing here is the velocity of money for investors, right? Nithesh and I have done a lot of investor boot camps. Get in, get out, get in, get out. Do not hit a home run. Have a process, move the property fast, expect a reasonable rate of return. You'll do very well. If you watch to flip this house and you're going to make $189,000 in 30 minutes and everything's going to be perfect, right? You're probably not going to be successful.
Yeah, I think we all need that reality check. So
very true.
Thank you, gentlemen. Always a pleasure. Thank you for the wealth of information here and calming everyone down about where we're at. So I think this was a great show, and we'll catch you on the next one.
Perfect. Thank you, Cindy.
Thank you for joining us for FDM Brews. Our team is here to answer your questions. Just call 239-359-6590 or email us at dfry@fdmhome.com.